All right, class. Today we're gonna finish chapter 2. So you can think about this is our June 7 class. So in the last video, we actually talked about we have to pay tax, right? We have to pay tax whatever income we are on. So think about as our personal income versus corporate income, we have to pay tax. So when you talk about tax, so tax basically charged or deducted in two different ways. So broadly, one is known as flat tax rate, and the other one is known as progressive tax rate. Now, what is the difference? So when you say flat tax rate, so that is basically one tax rate. So right now for corporations, it's 21% flat tax rate. So if any corporations earn, let's say, $1,000, so they have to pay 21% of $1,000, which is $2,100. Okay, flat. Whatever your income, doesn't matter, 21%. On the other hand, progressive tax rate means your initial income will be charged less. Your income after the initial amount will be charged more. So let's say this way. One corporation earned $1,000. So maybe their first $100 will be charged at 10%. Next 100 will be charged 15. Next 500 will be charged 18. So the thing is that the more you earn, the more you are paying, like a progression and the tax rate, which is going up. So this is called progressive tax rate. So these are two different ways of charging tax. So before 2018 or 2017, all personal and corporate income tax, both were progressive. But maybe in 2017 or 2018, federal government decided only personal income will be progressive, corporate income will be flat, okay? So if you know flat tax rate is very easy, just charge that percentage on your income. But for progressive, we have to be careful. So let's go to here. This is a progressive tax rate for corporation in 2017, because after that, now it becomes flat 21%, okay? But for personal income tax, let's say I work for Truman or I work for Walmart, my personal income is still progressive, but corporations become flat. So let's say this is the progressive tax rate for corporations in 2017, and we have to calculate the tax bill, okay? Tax bill. So how to interpret? First $50,000, 15%, first $50,000. From $50,000, $1 to 75, those additional $25,000, okay, will be charged 25%. Additional 25 up to 100,000, 34. Additional to $35,000, 39%. So the progressive means first part will be charged at a rate, after that different rate, after that different rate, okay? So that's the progressive tax rate. Now let's say the corporations you're working for, Intel, earns $4 million this year, 4 million. Now, what should be the tax bill? So when you say tax bill, that means end of the year, how much in absolute dollar amount the corporations will pay tax to the government. So I just copied this table. I just copied this table here, okay? Same thing. Now we decided the total income is 4 billion. So 4 million, right? Okay. So first 50,000, 15%. Next 25, 25,000%, okay? Next 25. 34. So we have to go until 4 million. I think 4 million ends here, okay? Because this is the progressive tax rate, anyone earning from 335,000 to 10 million. So we have to go, I can just drag this one until this. So yes. But the problem is, if I drag like this, we are considering our income is 10 million, okay? But our income is not 10 million. So what we have to do, make sense? So first 50,000, 15% from 50,001 to 75, 25%, after 75 to 100,000, 34, after 100,000 to 335,000, 39, and after 335 to 400, 4 million, okay? 4 million is 34. So the total tax bill is basically this much. So the idea is, if corporations earn $4 million, and this is the progressive tax rate in 2017, corporation has to pay $1.36 million worth of tax. Make sense? 1.36. Now, there are two more terminologies. One is called average tax rate, one is called marginal tax rate. So when you say average tax rate for the corporations, average tax rate for the corporation means total tax bill divided by total taxable income. Taxable income, okay? So net income is basically, so this is total taxable income. So don't get confused, okay? So net income gonna be total taxable income. This is net income, okay? So average tax rate, total tax bill divided by total taxable income, okay? Now, marginal tax rate. So the definition of marginal tax rate means if you earn one additional dollar after this amount, what is the appropriate tax rate for that additional $1? So right now, the corporation is earning 4 million. So that means if the corporation earned 4 million $1, for this additional $1, they have to pay this 34%, okay? They have to pay this 34%. So marginal tax rate is basically 34%. Definition, marginal tax rate. For the next dollar you earn, what is the appropriate tax rate or the appropriate tax you have to pay for additional $1, marginal tax rate? So let's say you work 1 8 to 5 job. Now you want to have a second job after 5. So you have to think about, if I earn one additional dollar, what is my appropriate tax rate for that one additional dollar? That is marginal tax rate. Average tax rate, the total tax bill, end of the year, how much tax you're paying to the government, divided by taxable income. That is average tax rate. Any questions you have, feel free to shoot me an email if you don't understand how I did it. So I'll be happy to help, okay? Now let's move on to some cash flow concept. So far we learned that from the balance sheet, assets should be equal to liabilities and equities, right? Now we know that if we buy asset, that asset will generate cash, right? If we have some liabilities and owner equity, we have to pay them cash. So for liabilities, we may need to pay interest rate. For equities, we may need to pay dividend. So in that regard, any cash flow that is generated from assets should be equal to cash flow paid to creditors, cash flow paid to stockholders. Okay. So basically, cash flow from assets should be equal to cash flow to liability plus cash flow to equity. Okay. Now, what are the sources of cash flow from assets? What are the sources to cash flow to liabilities and equities? So basically, those are standard formulas. So I appreciate to know these formulas, okay? So cash flow from asset is basically operating cash flow divided by net capital spending. Sorry, not divided by, sorry. Operating cash flow minus net capital spending minus changes in net working capital. Okay. Operating cash flow minus net capital spending minus changes in net working capital. So now operating cash flow, EBIT plus depreciation minus taxes. So we know this, right? We know it's from income statement, right? So if you go your income statements, income statement, EBIT is 694. Okay. So here is the EBIT, right? 694, right? And then from EBIT, your job is to add depreciation, which is 65. And then deduct taxes, which is 131. So go to income statement, pick those values, EBIT plus depreciation minus tax. So basically 694 plus 65 minus 131. So if you do that, the answer should be 628. Come down here. $628, okay? Now, net capital spending, okay? So net capital spending, the formula is ending net fixed assets minus beginning net fixed assets plus depreciation. So just follow the formula, because on the test, you should have the formula, just plug in the values, okay? So I'm just showing you where you're going to get the values so that you can plug in. So basically, we are working on 2018, right? So 2018 is current year, 2017 is last year, okay? So this is what 2018 ending value of fixed assets, okay? This is basically 2017 ending value of fixed assets. So be careful. When you say 2017 ending, that will become 2018 beginning. Same thing. Last year ending is equal to this year beginning. So 1709 plus 1644, sorry, 1709 minus 1644 plus depreciation comes from here, 65. So if you do 1709 minus 1644 plus 65, you're gonna get 130. Changes in net working capital, that is basically ending net working capital minus beginning net working capital. So we learned that net working capital means current asset minus current liabilities. So in that sense, this year, current asset minus current liabilities, okay? Current asset minus current liabilities minus last year current asset minus current liabilities. So that is net working capital. Okay. So if you plug in the values, you should get 391. So cash flow from asset is basically operating cash flow minus net capital spending minus changes in net working capital. 628 comes from here, minus 130 minus 391. So 107. So that's cash flow from assets. And we know that cash flow from assets should be equal to cash flow to creditors and stockholders. So cash flow to creditors, interest paid minus net new borrowing. So you have to be careful what is net new borrowing. So if your debt goes up this year, debt value goes up this year, you are borrowing more. So that means ending debt minus beginning debt. Okay. If your debt goes down this year, you are borrowing less. So basically, if you go to the formula, and if you go to the income statement, interest paid 70, okay, minus long-term debt 454 minus 408. So let me explain this one a little bit more. So cash flow to creditors is right? So interest paid, you're gonna get it from income statement, which is $70. So net new borrowing. So this year debt is more than last year debt. It's new borrowing, okay? So that means this year debt minus last year debt. So this year debt was 454 minus last year debt was 408, okay? So this is cash flow to creditors, which is 24. Same way, dividends paid minus net new equity raised. So net new equity raised means if common stock this year is more than last year. So dividend paid is basically, you're gonna get it from income statement, 123, dividend paid. And then common stock increase 640 from 600. So $40 more issued, more equity issued, new equity. So 123 minus 40. 123 minus 40 should be 83. 83 plus 24, 107. So cash flow from asset should be equal to cash flow to creditors, cash flow to equity. Make sense? So I just want you to know this formula, that's it, and how to get the information. That's it, plug in. You don't need to memorize, because on the exam, the day before exam, you should email me about the formula sheet you want to use. I'm gonna approve it and you can use the formulas. Formula has no issues, don't need to memorize, okay? Now let's do this problem, okay? So how to calculate operating cash flow? So it's trying to tell you net income 329, total sales 1340, cost 740, depreciation 130. So we know that operating cash flow, ROCF, is equal to EBIT plus debt minus tax. Okay, so it should be plus. Okay, so EBIT is basically, you want to think of EBIT, sales 1340 minus cost 740 minus depreciation 130. So that is EBIT. Okay. Depreciation is 130 minus tax is 13%. Okay. So now to calculate tax, what do you need? So to calculate tax, you need taxable income times tax rate. So tax rate is 30%, but what is taxable income here? So taxable income, do I have the information? Do I have sales? Yes. Cost? Yes. Depreciation? Yes. Do I have interest is 0? Okay, that's good. So I can easily do taxable income. So let's do. So taxable income, we have sales 1340. Do we have cost 740? We have depreciation 130. And interest is 0. So tax should be 141. Plug in here, 141. So if you just do basic deduction and summation, OCF for this example is 459. Now the good thing is, we covered problem 4 in homework 1. If you still have problem, if you still struggle, feel free to let me know. There should be a OCF problem in the exam 1, midterm 1, okay? So make sure you understand the formulas, make sure you know from where I should plug in the informations, and then basic summation and subtraction. That's it. If you still struggle, feel free to talk to me. And then one more problem. Firm has 97 common stock paid in surplus 340, and then current asset 460, net fixed asset 670. What is the amount of stockholders' equity? Okay. So stockholders' equity, what is stockholders' equity? Stockholders' equity is basically, if you go there from balance sheet, stockholders' equity is basically common stock plus paid in surplus plus retained earnings. Okay. So if we go here, stockholders' equity is basically common stock and paid in surplus plus retained earnings. So we have common stock $97, paid in surplus 340, but we don't have what? We don't have retained earnings information. What you can do, we know that asset equals to liabilities plus equity, right? So that means equity means asset minus liability. So what asset we have? We have $460 of current asset, we have $670 of fixed asset, minus we have $445 of common liability, total liability, right? Do the subtraction addition, 460 plus 670 minus 45. That's it. Okay. So that's all for this class. So we are done with first week of lectures and we are done with chapter 1 and 2. Feel free to let me know if you have any questions. Thank you.